Okay, everyone. Evening, everyone. I hope you guys are having a lovely day. Are you guys able to hear me? And are you guys able to see the screen also?
Yes, we can hear you.
Okay, perfect. So, um, before we can start by doing anything, let me just check the chat box. Okay, great. So, I want us to read the background information of this company before we can indulge into this question, right? Um, this wasn't a difficult question, but it got tricky at some point. And but we'll see how we're going to fix those tricks that they try to trick you with, right? Okay. So as it says My Taxi Limited is an authorized financial service provider and a credit provider listed on the JSE with a market capitalization of 360 million, right? So the moment you see a company and you are given a market capitalization, know that this is the value of its shares, right? So basically, you need to understand what market capitalization is. So essentially, in basic terms, it is the value of a company that is traded on the stock market, right? So essentially, the value of a company is what you will take into your account when you are doing work, for example, as you would have a portion of ordinary shares, right? So this is the market value that you can use, as this is also traded on the JSE. So essentially, it is what's on the market, right? So this company has a financial year end of 30th June 2023. The company was founded by two brothers whose vision is to empower South Africans to become financially independent taxi operators. A recent study shows that 30% of South African commuters prefer minibus taxis as a reliable and accessible mode of transport. Let me just check the chat box. Okay. Is my network breaking or
Sounds good.
okay?
Sounds good.
All good.
Good on my side.
Okay, let's comment. My Taxi provides its clients with a finance solution to help taxi operators, taxipreneurs buy taxis, and build sustainable businesses. Traditional South African banks are reluctant to provide funding to aspiring taxi operators as financial assistance to these taxipreneurs is considered high risk due to limited credit history. So, by reading this scenario, I can already think that somewhere, somehow, sources of finance will be integrated because of now. My taxi provide its clients with finance solutions, right, to buy taxis. So I can put sources of finance as a trigger here and continue, right? So in order to mitigate its risk, my taxi uses the services of of a third-party company to conduct the due diligence on all new loan applicants. A prospective client must meet a set list of criteria to be approved. My taxi has just spent a substantial amount of money to procure a new system with machine learning capabilities where all this data is stored. The new system ensures a seamless application process which makes it easier for an individual to apply for taxi finance with My Taxi. Let me just admit people from Okay. The client identifies the taxi they would want to buy at the dealership of their choice and then approaches my taxi for funding. The taxi is essentially purchased by my taxi on client's behalf, and once it has been paid up over a specific period, the ownership of the taxi passes to the client. The company charges its clients higher interest rates than other formal banking institutions, right? So mainly this is because of they are high risk. So throughout the duration of the finance period, the clients are responsible for fuel, insurance, repairs, and maintenance of the taxis. At any stage during the agreement term, if the client cannot repay the interest plus the capital portion as contractually agreed, steps are taken to recover amount owed, or at its worst, my taxi repossesses the taxi from the client. Only once the payment term is over and all payments are made, ownership of the taxi passes to the client, and together with legal ownership, the responsibility for paying all other costs remains to the client. So the 2023 financial year was challenging for my taxi. Scoring interest rates and a declining economy in general put the company's liquidity, in general, put the company's liquidity under pressure. So, meaning that this company is facing financial issues, and this would be a risk indicator for you should you discuss a risk question, right? A larger than usual percentage of clients defaulted on their repayments, leading to impairment of loans increasing by 7% year on year. A substantial amount of legal fees was paid to a law firm for legal advice as well as debt recovery. The finance team has provided the following information, right? So now, this is where we need to start strengthening our answering technique or our reading technique, right? So now, this is just an overview of the company, right? So I am given the statement of comprehensive income as well as the statement of financial position, right, at year end. So now I am going to read my required, right? I need to sort my required to the relevant topics that I am being assessed on, right? So when I see SWOT analysis, I know that majority of this, it will be strategy, right? And financial risks, obviously I'm dealing with risks. Calculate the weighted average cost of capital. I know that I have to deal with WACC. And then demonstrate with supporting calculations how the taxi rental project should be financed, right? So I know that I have to deal with sources of finance, right? So discuss factors my taxi would need to consider in deciding which rental option to implement as set out in part B of the scenario above. This is a combined theoretical question, right? So you can put it aside. So now I want to focus on the difficult component and where you could score the most marks, right? So obviously with strengths, with strategy, it is nothing difficult here, so I'm not going to go into it in detail, right? So would rather use this time on things that are difficult. So SWOT analysis, we all know by now, it is your strength, it is your weaknesses, opportunities, and threats. So when you are discussing this, you have to discuss under strength, under weaknesses, under opportunities, and under threats, right? And one thing that can help you in such a discussion is that with strength and weaknesses, these are internal. What does that mean? Within the company. And then with opportunities and threats, these are external, right? So strengths and opportunities, this is positive, basically. And with weaknesses and threats, this is negative. So you can use this matrix to help you formulate your discussion, right? So now, list 4 financial risks for my taxi, and for each risk, motivate in insufficient detail why you say it is a risk. So this is very basic. I'm going to provide you with a diagram that you can use, because of that diagram has all the risks that you can ever find in a test, right? So this one you can also check the scenario, I mean the solution, so it is not difficult. So the tricky parts, they start from C. So we need to calculate the weighted average cost of capital based on market values of the existing permanent sources of funding at year end. So what you need to know is that you are required to calculate WACC based on market values. Normally, when they don't tell you that you have to calculate it based on market values, you would use the target capital structure, as that is the preferred one to evaluate any investment that you would want to make, right? So, first of all, I just want to go through WACC, right? So, essentially, what can we say is WACC? So, WACC is basically the return a company requires to cover its all sources of finance, right? So, within WACC, you could find equity and debt, right? So, normally with equity and debt, you would calculate them separately. And with debt, which is a loan, for example, this would normally be after tax, depending on the scenario, right? So your cost of debt would be after tax. And then with your equity, it will obviously be pre-tax. You will not reduce it with tax. And we need to understand why is the cost of debt net tax, right? It is because this is basically within the taxation rules, right? We will reduce the cost of debt by tax because it is deductible in terms of what? Section 24J2 of the Income Tax Act, right? So since interest is deductible, it reduces the cost that we are going to pay to the issuer of finance, right? So let me just accept these two individuals. Great. So we can also look at the cost of equity, right? So under the cost of equity, what I want to make you guys aware of, right, is that you can use two methods of calculating the cost of equity, right? Which is the dividend growth model, as well as what? The capital asset pricing model, right? So the dividend growth model can be manipulated and you will get your cost as basically D1 multiplied by 1 multiplied by growth over the market price. And with your capital asset pricing model, it would be your risk-free rate plus your beta in brackets, return on market minus your risk-free rate. So sometimes in the test, you can be given your risk-free rate as the government bonds, as they are risk-free. So if you are given that rate as government bonds, you should choose that one. And essentially, the return on market, if they want to trick you, they could say that it is the average shares traded on the Johannesburg Stock Exchange, right? But in most cases, they will not trick you. They'll give it to you as the return on market, right? And this, the net of these two, is called the market premium. So if you're given the market premium, you can simply input it into your formula, right? So beta is just an indication of the volatility of a share on the JSE, right? So now these are the two formulas that you need to know for equity when you are calculating the cost, right? So when you approach a question, because of at most, you will not know which one to use, right? Which formula to use. So the trick here is that if you see a risk-free rate in a question or beta or a market premium, choose the capital asset pricing model as the method that you are going to use to calculate the cost of equity. This one is always preferred if it is in this scenario. Then if there is no component of this formula in this scenario, then you can default to the dividend growth model. Then you should be able to calculate your cost. Right. So now let's attempt the calculation of the WACC. Right. So any questions before I can continue with the calculation of the WACC?
Can you please just repeat what you said about if you given something, then you can use one method against the other, or you can default to the capital asset pricing method? I missed that point.
Okay. So let me just do this. Okay, great. So now what I'm saying is that if you are given the risk-free rate or beta in your scenario, you should use this CAPM method, right? As it is a guideline for you on which method to use, right? You start here. You do not start with the dividend growth model. This is your last resort. When all else fails here, you are failing to identify the risk-free rate, right? So did I answer your question?
But I don't understand.
Come
Yes, you
again.
did. Thank you.
Okay.
I can't hear.
Oh, yes, I have a question quickly, just on the CAPM as well. You said the risk free, what is this RM minus RF? You said then this net amount, what is it called?
Market premium. So if you are given a market premium in your scenario, you would use that amount and you would ignore this part. Does it make sense?
Yes.
Okay. Any further questions before we continue? Okay. So now with the calculation of the WACC, they required us to calculate the weighted average cost of capital based on what? Based on the market values, right? So now our approach, we have to look for the market values. We shouldn't waste time looking at a lot of things, right? You go straight to the market values, right? And the best place for you to find the market values, it is on your statement of financial position. Remember, time is not of the essence when you are writing a test, right? So now you should go to the portion that is relevant, right? So it is always advisable to read your full scenario, but you can only do that if you are very fast in writing and in reading. But if you take time to read and write, every time you read the required, go to where it is applicable, right? But there are some instances where you cannot do that, right? For example, when you are dealing with strategy, there's no way that you can just skip to the relevant part because of it can be spread all over, right? But with a question like this is basically when maybe you are left with 30 minutes and you want to attempt a question and you don't want to read everything. You can go directly to where it is applicable, right? So if you are left with maybe a couple of minutes before your time ends, go to the question that you can find its information um, in a way that you would not have to read a lot, right? So let me just do this. So please let me know if you guys are able to see both of the screens, right?
Yes, we can.
Okay, great. So now we are going to start with the easiest one, right? So the easiest one in this case can be debt, right? So, or point number 2. Then, only then when you get here, let me just do this. Okay, so now, point number 2, we go to where it applies. A long-term loan, right, of 75 million from SABA Bank was taken out on the 1st of July 2020. It incurs an annual interest of prime less 150 basis points, and interest is paid annually in arrears. The full capital amount will be repaid on 30th June 2030, right? So similar loans bear an annual interest at prime less 75 basis points. Okay. So now the easiest one for me to calculate with debt, it is always the cost. So do not let the word cost confuse you. When we are dealing with WACC, cost is the percentage. Do not write any amount there. It is a percentage, right? So now we are doing the cost of the loan, right? And the cost of debt is the market-related rate. So what is the market-related rate within this scenario? The market-related rate, it is the annual interest of similar loans because of it is the one that is traded freely between the market participants, right? So it is prime less 7.5 basis points. So now you have to look for the prime rate, right? That is provided in the scenario. And normally you'll find this at the end of the question, right? So they are telling us that the prime is 9.75%. This is where I got this amount, right? Let me just do this. Right. So I have to reduce what? 75 basis points. Okay. So 75 basis points, right? Basically, how you do this is that you put a comma after two numbers, right? So meaning that after 2 digits, you put a comma. 1, 2. So you put a comma here, right? So meaning it would be 0.75. So every time after 2 digits, you put a comma. So now you have a interest of 9%, right? But now our taxation rules are triggered. Section 24J2, it says that interest, it is deductible for tax purposes, right? So we will now have to reduce this 9% I'm going to have to reduce this 9% with the tax, right? And we all know by now that tax is 27%. So I am going to reduce this with tax. So meaning this is 100%, and I am going to reduce it with the 27%. So basically what I am doing, right, is I'm taking this 9% and I am multiplying it by 73%. So this would give me an amount of, let me just take out my calculator. So 9 multiplied by 73, right? So it gives us an amount of 6.57%, right? Okay. So now this would be your cost of debt as it is after tax. So any questions before I can continue? Because of you have to know this. You have to know this part that it is always post-tax, right? Net tax value.
Can you please explain where you said that? I didn't see where your mouse was pointing when you were talking about the commas on when then you came up with the 0.75.
Okay, this part. Okay.
Yes, that one.
So now we are told that similar loans bear annual interest at prime less 75 basis points, right? So when you are getting basis points, right? So you have to essentially, or let's do this. The one of moving 2 digits might be complex. Always divided by 100, right? So take your basis point and divide it by 100. You'll arrive at the interest, the percentage, right? So that's when you can use.
Okay, I get it now. The 75, not 0.75.
So any further questions?
Okay, I get it.
The 9.75, where did you get it?
9.75. They told me that interest.
Oh, prime rate. Okay.
Yeah.
Okay.
Rate.
James,
Yes.
would I, is it compulsory to say 100 minus 100%, calculating the pre-tax? Is it compulsory to say 100% minus 27%, or I can just say one minus 27%?
1 minus 27%.
Yes, because I'll still get z- 0.73.
Okay. Yes, you will get the same answer.
So which
Essentially
method
because
is?
essentially 100% is equivalent to 1. So you would get the same answer.
So when marking, which one is?
Both of them
Which?
are correct.
Okay. I think.
Because essentially you understand the principle of removing the tax. So you are essentially correct. The most important thing is understanding the principle. So there's a question in the chat box, sorry. It says, why are we using the 75 basis points instead of the 150? The reason is that we are looking at the rate of similar loans. We do not look at the rate that we are paying, right? We look at the market-related interest. Okay, you can ask your question.
No, I just wanted to ask the same question that was asked. in the comments.
Okay, perfect.
But if I can just ask a further question is why are we like specifically using that rate that is similar to what is being used in the market? Why specifically that? If I don't know, I'm not sure if I'm making sense.
Remember the cost of debt, right? It is the market related rate. So we want to find out how much it would cost us to borrow money in a normal world, right? So we do not want to use the interest that's favorable or unfavorable to us. We are basing it on the market.
Okay, that's great.
Yes.
Thank you.
So now let me move, guys. The rest of the questions you can send to me on WhatsApp, right? So now we are done calculating the cost, right? Now let's calculate the market value, right? So as I am calculating my market value, right? I'm using the same scenario. Nothing changes. And now I see that, okay, I have to repay this at a later stage. And I'm paying interest annually. So what's been triggered to me? TVM. So I'm calculating the market value of the loan, right? And the market value is essentially what? The present value. So this formula for me would be the most ideal, right? Because of now, I would have my N, my I, PV, PMT, and future value, right? They are telling me that the full capital amount will be repaid on the 30th of June 2030, right? So now, I want to ask someone this question. I want to ask, who am I going to choose? So Adele, do you mind telling us what would be our future value?
Wouldn't it be the 75 million?
Yes, great. Because of this would be the amount that we'll be paying in future, right? Okay. So now from the current year to the date of payment from the 1st of July 2020 to the 30th of June 2030, it is 7 years, right? Now, the interest, I'm going to use the one that I have calculated, right? Which is the 6.57%, right? And then payment, we are making annual interest of prime less 150 basis points. So now with the PMT, that's when this 150 basis points can apply, right? So essentially, I'm going to take my prime. What was my prime again?
Sorry, James. How did we
Yes.
get to 7 years when it's clear from 2020 to 2030 is 10 years?
Yes, I also think it's just
We are going to be using our current year, right? Our current year end would be the determining factor as we are calculating the present value. And remember, present value is what? Is the value in today's terms, right? So, and today we are at the end of the 2023 financial year. So we cannot calculate the present value of 2020 because of it is not today.
Oh, I missed our year end, sorry.
So now I will essentially be doing what? I will essentially be taking my prime rate, netting the 150 basis points, and this would be 150 over 100. This would give me what? 1.5, right? Percent. So I'd be left with an interest of 8.25%, right? So now this 8.25%, I am going to multiply it with the par value, right? Meaning that the loan value, the loan amount, as we are going to be paying interest on the capital amount, which is the 75 million, right? So since we are dealing with an after-tax rate here, so we will automatically match our payments to be after tax because of we need to match the two, right? So as I put this into my calculator, I am going to arrive at an amount of, let me just do it. $6,187,500. Then now I can net my tax, right? With 73%. So essentially I am removing what? My tax amount. And okay, let me just recalculate. Any questions up to now while I am calculating?
Is it 73%?
Yes, 73%.
And you said, where did you get the 73%?
It is 100% net tax.
Thank you.
James, just to confirm, you said if they say five, like for example, 5 basis points, you just take 5 and divide by 100.
Yes.
Okay. Thank you.
So now we are going to compute our present value, which is the one that we are looking for, right? So as I am going to compute my present value, this would be my missing figure, right? And it is a loan. So this would be in negative as it will be an outflow at the end of the period, right? And then the payments are also going to be an outflow because if I'm going to be making payments, right? Then I am going to input all this amount into my financial calculator, right? And after computing this,
72753.
come again.
7275347,457.82.
Great. So now this would be what? My present value. And my present value is essentially my market value, right? I'm not going, okay, I can only take one question, right? So that we have to move because we also need to do the other tricky part of this question paper. So who's willing to ask a question or who has a question?
Somebody asked in the chat room that how did we got 8.25?
How did we get 8.25? This one. So it is essentially our prime rate less the 150 base points, right? So, Shiraz, can I take your question?
Sorry, James. I'm getting a different amount to the one that we've just had. So my present value is 720,33665.
Okay. You'll send me a message on WhatsApp and then I'll show you your mistake or where you're getting it wrong.
Okay, thanks.
No problem. So now let's go to the other portion. They are telling us, right, that 5 million debentures were issued on the 1st of July 2022, right? At their nominal value of 10 rand each and will be redeemed on the 30th of June 2026 at a premium of 6% of the nominal value. The nominal amount will be repaid on the 30th of June 2026, but the premium 12 months late, right? Interest is paid annually in arrears and the nominal interest rate on the debentures is 9.5%. The current market rate for similar debentures, it is 8%. Nolutando, can I take your question?
I'm sorry, sir. Can you please just show me the screen for the last time? I just want to take a screenshot of the calculation that we just did. Thank you.
No problem.
Thank you, sir. I'm done.
Yes, no problem. Just doing something. Okay, so now, where are we? Where are we? Okay, debentures. So we have to calculate the cost of debentures, right? Debentures is debt, right? And it is the easiest one to get, the cost, right? So we just have to look at the current market related rate, right? So what is the current market rate? The current market rate is 8%, right? So it is this 8%. So I am going to be taking this 8% and I am going to multiply by 73% because of I am going to reduce the tax, right? So now I am going to arrive at an amount of 5.84, right? And then I am essentially done with the cost of debentures. Now I want to get the market value, right? So as I am going to do the market value, I can see that there's a problem with this scenario. And my TVM calculation is not going to work, mainly due to one reason. And this reason will be the fact that they are uneven cash flows. So I cannot use the PMT because of they are uneven. Because now, these debentures will be redeemed on the 30th of June 2026, right? And a premium will also be redeemed 12 months later. So I have a problem. Now I have to use my cash flows, right? So I'm going to do a table for myself, right? Being 2023, which would be the 0, and then 2024, 1, 2025, 2, 2026, 3, 2027, 4, right? I am only going to stop at 4 because of the premium will be paid 12 months after 2026, right? So every time in year 0, when you are doing cash flows, right, you do not include an amount, right? Because of you are essentially at year end, right? You only include amounts, let's say maybe you are evaluating an investment, right? Maybe there's going to be an inflow on year 0, and we are wanting to calculate the market value of debentures. That's when you can add it. But now you do not add it because of you only want the market value of debentures, the amount that you are going to pay. But if it was an investment, we could have added it. So this would be essentially your case when you are dealing with an NPV, which is not part of your test now, right? So for 2023, it is 0. For 2024, right, we have to get the coupon payment, right? And what is the coupon payment? What is the coupon payment? They are telling us that interest is paid annually in arrears, and the nominal rate is 9.5%. So what must I do now? I am going to take the 9.5% and I am going to multiply it by what? By their par value, meaning that the value of the debentures, the value the debentures were issuing at. So essentially your par value is the same as your nominal value, right? So your par value is the same thing as your nominal value. So I would take this 9.5% and multiply it by my nominal value. So 5 million debentures were issued for 10 rand each. So that would be 50 million. So I'll take my 9.5 multiplied by 50 million, right? And then obviously I'm dealing with debt. I'll net the tax, right? So I am going to input this into my calculator, right? So 50 million multiplied by, let's see,
34675
467,500. Okay, thank you. So now this is going
Sorry,
to,
James. Please, can you repeat how you got this amount?
so I took the interest rate of the interest payments that I'm going to make, right? And I multiplied it with the face value, nominal value or par value, right? You can call it one of the three. So, and then I wanted to reduce this interest payment with tax because I know SARS is going to allow me a deduction. So I'm essentially going to reduce it because of this will not form part of the cost of the debentures, right? So that's how we got this 3 million amount. Is your question answered?
Yes, thank you.
Okay, so now This would be my cash outflow, right? Within the first year, right? So 3, 4, 6, 7, 500. And then in 2025, it would be the same because of there's no additional outflows that are being made. But now in 2026, I still have this amount 3467500, right? But now these debentures are being redeemed, right? At the nominal amount, which is the 50 million, right? And the premium 12 months later, meaning that we are taking this 50 million and we are going to multiply it with what? With the 6%, as this is the premium, right? So essentially, this is going to give us an amount of
2 million.
2 million. Okay.
3.
3. Then this 3 million, we are going to net tax from it, right? So everything in here needs to be matched. And the key reason that we are not netting this repayment back, it is because of if we go back to our tax rules, this is capital in nature, right? So the amount that you're going to be paying back, it is capital in nature. So we will not be allowed a deduction by SARS on amounts that are capital in nature, right? Okay. So now, we'll take this 3 million and reduce it with the tax, right? So the premium, they will see it as interest. And now this would give us an amount of 2,190,000, right? And only now I can start using my interest rate, right? This 5.84, sorry, this 5.84 is going to be my IRR, internal rate of return, right? Meaning that it would be the interest. When we are dealing with cash flows, you can call it the internal rate of return. So now I am going to input all this amount into my financial calculator, right? So those of you who do not have financial calculators, it is very important for you guys to get them because of it would be very difficult for you to calculate and time consuming to calculate this amount using what? Using the amortization table, right? It would be very difficult. So now, what are we doing now? We are imputing this amount into our financial calculators. And let's see the amount that we will arrive at. So meanwhile, who has questions?
Yeah, I have
Sorry,
a question. Sorry. I have a question on the present value amount. How much was it?
Present value, you referring
The
to long-term loan?
yes, yes.
Okay.
I just want to not fall behind in terms of, like, for example, you told the other lady that you will just you will answer her on WhatsApp regarding where she went wrong in terms of the financial calculator, I gather. Now, when everyone gets a different amount depending on how they inputted the numbers in the financial calculator, then it would mean that when you explain to her, we won't get an understanding, and we also might have the same answer as her, and where we went wrong on that. But we can go back to it at a later stage, I guess.
Okay. What amount are you getting?
I'm getting 72,187,553.86.
Okay, let's input the amount together.
Okay, cool.
Sorry, James, I did go double check mine and I'd actually swapped my interest rates around. So it was 6.75 instead of 6.57. So mine is sorted.
Okay, great. So when you are inputting this amount, what amount are you getting?
I just cleared it, but I'm getting 72,187, 553.86. I think maybe I did the same mistake as that. Yeah.
So you can please also ask, is your calculator on end mode? So sometimes if your calculator is on begin mode and it's payable annually, you're not going to have the correct answer.
Okay. Yeah, then we can continue. I'll just work on the calculator.
Okay. Any questions?
Yes,
Hi.
sir. Sorry.
Oh, actually, I go first. I just
Yes, you
want to
can
find
continue.
out. Okay, thank you. I just want to find out why, um, on the what's this say on this table for the years 2024, 2025, 2026, you use the same amount. Like, why is the amount constant?
For the 2024, 2025, 2026 year.
2025, 2026. Yes.
Okay. Essentially, it is consistent because of now we are paying interest rates, right, on the nominal amount, and the nominal amount is consistent. This 50 million is consistent. So if we are multiplying it with a consistent rate of 9.5 net tax, right? It would also be consistent because of we are doing the same inputs over and over. If this was fluctuating, then it would be different. If the interest component was fluctuating, then the amount would be different. But now they are not telling us anything about us making payment of the nominal amount, right? So we are going to be paying the nominal amount at the end of the period, right? So essentially, I expect all my cash outflows to be consistent. Does it make sense, or should I explain it again?
Okay. No, it's okay. Thank you.
Okay. What's the other question?
No, sir. I had the same question as how I'm sorted now. Thank you.
Okay. Great. What's the other question?
Sorry, are you gonna post the recording after class?
Yes.
Marion.
Okay, thanks.
Okay. So now, yes, is there anyone who wants to ask a question also? Umpumeti?
I know I'm good, man. I'm just working on my calculator.
So now,
James, I do have a question.
yes.
So what I want to ask is that if have they said anything on the scenario that interest rates will be fluctuating, how would then the question, like those cash flows change? Or from what point will we start to see the point? I mean, they change based on the dates, or how would it be calculated now?
So let's say now 2020, you have an interest rate of 10%. 2021, you have an interest rate of 15%. 2022, you have an interest rate of 20%, right? 2020, okay, 2020, 2021, 2022, 2023, you have an interest rate of 15%. So and your nominal value is 50 million. So essentially what you would be doing for this year's, right, is you would be multiplying with the respective interest rates. So you would take this 50 million, multiply by 10%, giving you 5. You would take this 50 million, multiplying it by 15%, and this would give you 7.5. And 50 million multiplied by 20%, this should give you 10. And then 50 million multiplied by 15% again, this should give you 7.5. So this is how your outflows would be different. But I don't expect you to be assessed at this level.
Oh, okay, that's fine because I was gonna ask if they will always give you those percentages if they told us that the interest rate will be fluctuating. We won't be expected to like anyway, that's fine because you're saying you don't expect us to be tested on this level. Thank you.
Pleasure. So, okay, so now we can move to what? To the ordinary share capital, right? Bank overdraft, you do not consider it. Anything that is not permanent, you do not consider. Bank overdraft is a short-term thing, so you would not consider it, right? So we will look at the ordinary share capital, right? You would ignore. So now, ordinary share capital, point number 6. So the authorized ordinary shares is 10 million, of which 80% is in issue. Okay, so with ordinary share capital, I want to start with the easiest one, market value. The market value of ordinary shares, they told me. Remember when we started reading this scenario, we said this one is going to be very important. That's why I wrote it here. So now, this is when it would become applicable, right? Because of sometimes you tend up reading information, but you don't know where it applies. So if you get a trigger such as market capitalization right at the top or somewhere or in your on your answer sheet or wherever you are writing your answers on your Excel document that the market capitalization is 360, should you need it, right? Because of now, if you didn't know that market capitalization is the market value of a certain company, you would have spent a lot of time calculating the market value here, right? So now, cost of equity. Remember what we must do now. We have to look at what? If there is a capital asset pricing model, step number 1, very important. Then if we do not find that, we can default. So yeah, you have to invest your time towards the end of the scenario so that you try to find out if there is those inputs, right? So I can see there's a risk-free rate, right? And a market return and a beta. I conclude now that capital asset pricing model is the method that I'm going to use. I'm going to ignore dividend growth model no matter what, right? So capital asset pricing model, I have a market return, right? Okay, let me just put the formula down. Risk-free rate plus beta multiplied by risk-free rate less, the return on market less the risk-free rate. And this is also known as your market premium. So what's my risk-free rate? 7%. What's my beta? 1.5. What's my return on market? 11%.
11%.
What's my risk-free rate? 7%, right? So now you just impute this amount into your calculator. Then you would get the cost of equity. It wasn't very difficult, this one. This one, I think it was an actual giveaway because of everything was in front of you. The only place they tricked you is this market value because of, I think, most students would have calculated the market value. So now, this would essentially give us an amount of, let's calculate. So 13%, right? And remember, this is equity. Do not net tax on equity. You do not net tax. You only net tax on debt, right? So you only net tax on debt. If you're dealing with equity and preference shares, you do not do that, right? So any questions before we move on to the preference shares?
Um, James, I just want to make sure that I had it clear. Did you say the market capitalization is the market value?
Yes.
Okay, thank you.
Frida, what's confusing you? How do we pronounce your name? Okay, okay, no problem. So now we are moving on to the other line item, right?
Can I
We
please ask,
Yes, you may
sorry,
ask.
James, I want to ask something in terms of when you said do not net tax on equity. That's clear for me on the ordinary shares or ordinary share capital. However, in terms of the preference shares, if the preference shares are redeemable, that's dead. So I just want to understand that even though the preference shares are redeemable and they fall under debt, we still don't net tax on them.
Remember now, this goes back to the topic that you are doing in financial accounting, financial instruments, right? Now, remember, if you can avoid the outflow of cash, right? If you can avoid this, it is an equity component. If you cannot avoid the outflow of cash, it is a liability component, right? So if preference shares, for this instance, what do they say about preference shares? They are non-redeemable, right? What does this mean? It means that we can avoid the outflow of cash, right? It means it is an equity component, right? But if they say these are redeemable, right? So now they are a liability component. So meaning that this is essentially debt. You understand?
Yes, I do understand, James, but I was just asking in terms of like netting of tax, because on the debt, like if it's a loan, you will net tax. So I just wanted to ask if on the preference shares when they are redeemable, seeing that now they are debt, do we net tax or do we still just not net tax on them?
Okay. So remember, okay, maybe I didn't answer you correctly. So let me answer you correctly now. Preference shares, right? They pay what? They pay dividends, right? And debt pays what? I mean, loans, rather, not debt. Loans, they pay what? Interest, right? And if we were to reflect to our taxation rules, yeah, a deduction would be allowed in terms of Section 24J, right? Yeah, dividend, right? Dividend will not be allowed a deduction. Although they are exempt sometimes depending on the type, right? But they are not deductible, right? So now we would not use the post-tax, we would use the pre-tax, yeah? And then with the loan, we would use the post-tax because of we are dealing with interest, here we are dealing with dividends.
Thank you, James. Some answers.
So now we are going to look at preference shares. So they are telling us that those non-cumulative, non-redeemable preference shares pay out a dividend annually, right? And the market value is estimated 85 million at year end, right? So this one is also simple, right? Because of now, we are given what the market value as 85 million. So I do not need to calculate my market value. I can calculate my cost of preference shares now, right? Which would essentially be what? So I can see that I cannot use the TVM here. I cannot use the TVM because of I do not have a date of redemption. So a TVM needs to have what? 5 components: N, I, PV, P, PMT, and a future value, right? So I do not have an N. I can get the interest. I do have the PV. I can get the PMT, but I do not have the future value, right? And now I do not have the interest at one. So maybe even if I put this future value as 0 because of they're not redeemable, I'd be still left with 2 missing components. So this formula will not work. You cannot use TVM when you have 2 missing components, right? You can only calculate it when you have only 1 missing component. So I'm essentially assuming that I have no choice but to use the perpetuity formula. Because of this thing is paid for an infinite time, right? Which we don't know. So I'm going to use the perpetuity formula, right? So meaning that this is the amount that I'm going to pay over the market value. So it is 85 million. And how much are these dividends? How much are these dividends being paid? It is 85 million multiplied by the coupon rate. Where's the coupon rate here? 7.5% is the coupon rate. Remember, no taxation implications because of it is dividends, right? So this is going to give us 6,375,000, right? So if I divide the two amounts, I am going to arrive at an amount of, or at a percentage of 7.5%, right? Does it make sense?
James, can you please repeat that? Where we got that 6 million, please?
Okay, so this 6 million, I got it by taking this 85 million and I multiplied it by the coupon rate, the payment rate. which is 7.5%. Does it make sense?
Yes, thank you.
Okay. Anyone who also has a question?
Hi, James.
Hi, how are you?
Good, thank you. Sorry, I have this question. I know it's very simple, but is there a reason we're multiplying the coupon rate with the market value? Sorry, I'm not understanding that part.
Okay, so the reason why we are multiplying the coupon rate with the market value, it is essentially because of this is our dividend rate, right? So this coupon rate is the payments that will be made, right? So we are going to pay these people 7.5% of the market value of the preference shares at any given time. So essentially, dividends are 7.5% of the market value. Does it make sense? That's why we are
Yes, it does.
multiplying.
It does. Thank you so much.
Any other question? Okay. So now, since I am done with all my inputs for the work, so I can put everything into a work calculation, right? So when you are putting everything into a work calculation, right? Obviously, you will have your details here of what are you going to put, right? What did we calculate first? We started off with our loan, right? So the present value of our loan was this 72 million, right? So let me just write it here so that I can transfer it easily. So this is the loan. And then we calculated the present value of what? Debentures, right? So this is the cost of debentures. What was our value of debentures again?
We never inputted it. We just flew.
We just flew. Okay, let's impute this amount. I apologize. So we have to impute the sum of this amount. Sorry about that. So essentially our IRR is still the same, right? So now I just have to get what? The net of this cash outflows. Right. So that is my total. So now I just need to compute this into my financial calculator. And then after that, I should get my amount, right? So what amount are you guys getting? So you have to start with 0, right? Being your cash flow 0, right?
I'm getting 9,296,175.
9 million.
Yes.
How did you impute your amount?
I'm getting 62,592,500.
You're getting 62 million. We are going to have a very
Yes.
big problem.
Let me try imputing again.
Let me,
Our IRR is 5.84.
yes.
Okay.
So let me impute again because of I'm getting a different amount. Let's see.
I'm getting 53 million.
Yes, I was getting that amount. So
Yeah, 53 million 212. I forgot to put the IRR. That's why.
okay.
But I'm getting 53,213,015.
Yes,
And
we are on the same track. So meaning that it is most likely that amount, right? So now that is our present value, right? So let me just write it here also. So who has questions on this?
Oh, Yimshan, James, I'm lost. Where are we computing? Like, I'm so lost.
Do you have a financial calculator?
Yes, I do.
What brand is it?
It's the HP 10V II Plus. Yeah.
So I don't know how to use an HP financial calculator. I've always been using a Sharp one, right? So if you are using a Sharp one, I was going to advise you on which input to compute. Who has a Sharp calculator and has gotten the same amount as us?
I'm using HP
You're
and I got
using,
the same amount.
Okay,
can
can
you
you
please
just
guide them?
tell me, can you just kindly tell me the thing is that we computing the numbers we're using and
If she's
yeah.
using HP, I can
You
help.
can just put it
I'm using HP. You can
in the
just
chat
tell me.
box. It will be
So
fine.
what you do is you go, obviously your PY is 1. So you go 0, then you say CF. I don't know if you see the CF button. CFJ.
Yes,
And
ngiyambona
then you
CFJ.
go 346750. You go back to the
3,
same
4,
button.
6, 7, 5, 6.
So you
0.
put again that amount, you go to the same button. This is the wrong approach.
Oh,
And
okay.
then you put all the other amounts, you go back to the same button. When you're done putting all those amounts, then you put your rates, which is 5.3, and then you second function and click your NPV. That's the long approach, but it's the simplest one.
Also, what you can do is that you can just Google how to do the cash flows on HP. It will just give you the steps, and you can follow those steps. It will show you.
Okay.
I always go to Google. It's helped me when it comes to the financial calculator, or even
Okay, guys.
YouTube.
Oh,
Anything.
okay, guys. I'll do that. If I encounter any problems, I'll ask James.
No problem.
Thank you.
Hi, James.
Hi, how are you?
Good in you. I wanted to find out, um, I'm not able to afford a financial calculator as of yet, so I've just been using a normal calculator. Is it possible if we can maybe, or how would you go through the steps of calculating the NPV? Because I don't have a financial calculator, so I'm not able to do it the way everybody else is doing it.
You can use Excel.
Okay.
Hey, great. Andre, you also got the right amount. Thank you. So now let's go to the market value of ordinary shares was 360 million, right? And then of preference shares, it was also given to us, right? As 85 million. So now I want us to compute or input this amount together. So we'd start by the loan being the 72753,458. Then debentures would have 53216,016. And then for ordinary shares, it is the market capitalization of 360 million. And then for the preference shares, it would be the 85 million, right? So what I need to do is get the total of this, right? So essentially, this would be my market values. Then after I get the total, I need to weight everything, or I need to prorate everything to give me 100%, right? So who already computed all the amounts for us? So we will arrive at 570 million 966 474. Okay, so now I need to weight this amount. I need to weight them so that they can amount to 100%, right? So essentially, I'm going to take this amount and I divide with this total. So essentially, you do this for everything to get the weightings. You take the first amount, you divide with the total. You take the third amount and you divide with the total, right? And you take the fourth amount and you divide with the total, right? So the amounts that you get would be the weightings that we will be using, right? So let's quickly do that. So here I'm getting 12.74. And here I'm getting 9.32. And 63.05. So the last one, you can use it as a missing figure, or you can compute it also, right? Which would give us 14.89. So these are our weightings, right? So now we need to bring in our cost, right? So our costs were, okay, preference shares, it is 7.5, right? What the amount for preference shares? 7.5. And then 5.84, this amount would be for what? Debentures. And then 6.57 would be for the loan, right? So For debentures, it is 5.84. For the loan, it is 6.57. And then for ordinary shares, it is that cost of equity that we calculated, that we use the capital asset pricing model, right?
13%.
13%. Thank you very much. 18%. So now this is 13%. So let me just do this because I don't need that anymore. So I do not need to get the sum of that, right? So now I need to get my WACC. So I am going to take this cost, right? 6.57. We multiply it by this weightings, right? So we will multiply this by this, this by this, this by this, this by this, right? So that would give me what? 83, I mean 8, let me just check. 8.4%. And then I take this 5.84, I multiply it by the 9.32%, which would give me the 0.54%. Then I take this 13%, I multiply it with the 63.05%. And this gives me 8.2%. And then I take the 7.5 and I multiply it with the 14.89. So this would give me the 1.12%, right? So our cost of preference shares, right, will essentially be different from the memo you guys will be provided, I think, because of now we are using the full amount. And I think on the memo, they used 6 million divided by 85. So a rounding difference is the one that caused this changes. Probably when you see, do not get confused, right? So now we are going to add this amount together, right? I'm going to take questions now after we are done computing here. So it gives me an amount of 10.70, right? So what's this essentially? This is my WACC amount that I'm going to use, right? So it is the return a company requires to cover all its sources of finance. Essentially, this will also be used to evaluate investment decisions, right? Now, questions? Laurentia?
Hello, James. I
Hi,
just
how
want
are
to,
you?
um, if you calculate the weight average cost, why do you not using the amounts in the statement of financial positions extract, and you only use the notes?
Okay. So remember, statement of financial position, right? It gives you your book values, right? So-called carrying amounts, right? And when we are evaluating investment decisions, we want to use the market values. So majority you would see in finance, we are dealing with market values as we are valuing a decision, right? In finance, you normally deal with market values. In accounting, that's where you deal with book values and carrying amounts. Unless if something is on the revaluation model or the fair value model, then it would be at the market value. So But the reason why we can't use this, it won't give us the return a company requires to cover its sources of finance, right? And it will not be relevant for investment purposes because of some elements may be undervalued, right? So did I answer your question correctly?
Thank you very much.
Okay.
James,
Yes.
I think she asked something that related to what I was gonna ask. I was just gonna ask that in terms of like calculating WACC based on market values, I think I'm fine because that's what you just did. So I failed to draw the comparison when they say calculate based on book values. What is the difference when you calculate it based on market values and when you calculate based on book values?
So if you are asked to calculate on book values, then you would use the items from your statement of financial position. But in a real life situation, you would not do that. But if a question appears like that, you'd use items from the statement of financial position.
And the market value we used statement of comprehensive income.
Market values you use the book value adjusted with the information that you are given. You do not use OCI. OCI will never provide you with your equity and your liability. Yes. I saw a hand whose hand was up. Was it yours, Ania?
Yes, it was mine, but I understand from her question now.
Okay. Guys, you need to understand this, right? Who also has a question? Because of this, is something that you need to know. It's going to be there in your test, and it's going to be there for a minimum of 10 marks.
I don't understand anything. So will this recording be sent so I can watch it over again because I'm lost?
Yes, the recording will be made available to you guys.
Thank you.
Pleasure. Anyone who's willing?
So
Yes.
James, sorry if I'm asking the same question. I just want to ask based on you said that when you said that for book values you use the statement of financial position. So if they asked us to calculate based on the statement of financial, I mean on the book values, does that mean that we're going to like sort of ignore that additional information and only use the what is provided in the statement body or what?
You ignore everything that relates to the fair value. But if they tell you that maybe the loan didn't take into account the capital portion paid, you would adjust for that because of that is an accounting adjustment, right? So you will ignore all your fair value adjustments and you will account for all accounting adjustments.
Thank you. That's clear.
Okay. Who's ended up? Sean, can I have your question?
Oh, hi. So I wanted to ask, not related to this question that we're doing, but the other part, I think it was part B on risk. You said there are notes that you send that will help us that will guide us when you're answering such a question. Could
Yes.
you please send those if you can?
Yes, I'll send everything together, right? So the interesting part
Thank
of the
you.
boot camp that people love, right, is the end part. So I wanted to do question D, right? It is very difficult and it's very difficult. This is the high level question that was asked. But due to the constraints of time, for the purpose of this boot camp, we will not be able to touch it because of it's going to take us an hour for you guys to fully understand, right? So now I wanted to do this one, but it's fine. I'll host this. Okay, no, let me know. It's fine. So now the topics that you need to strengthen, right? Topics to strengthen for Monday, right? Do 2 strategy questions, right? Which is going to count 10 to 5 to 10 marks. Do risks, which is going to count 5 to 10 marks. Then there might be a possibility that only one is assessed over the other one. It is also a possibility, right? Then the weighted average cost of capital, 10 to 15 marks. Whatever that we just did now, 10 to 15 marks, right? Then sources of finance integrated maybe with working capital. So here we are looking at this range is very broad, but let's do it like this. With the sources of finance, let's look at 5 to 10 marks. Then with the working capital, let's look at 5 to 10 marks or not being assessed. So here you do 2 questions of strategy, and here you do 1 question and look at the notes that I'm going to send to you. Make sure that this question you fully understand it, you'll get all your marks. And when you are doing risk, the question that's going to appear is the risk indicators. So you'll have to identify your risks, right? In a scenario, you have to identify what is the risks based on the diagram that I'm going to share with you guys. So you are going to find a couple of risks there. So once you see that risk, you identify it and then you explain it, right? So obviously, for example, if you're dealing with a currency risk, you identify that there's a currency risk. Normally, maybe this would be a foreign loan, right? So a foreign loan. So every time you see a foreign loan in your scenario, you know there's a currency risk. What is the risk? You paying more should the currency weaken, right? Should the rand, you can be specific, should the rand weaken, right? And then obviously sources of finance, obviously you'll ask to evaluate, and sources of finance, the easiest part is that for loans, interest is deductible, right? And with equity, it is expensive, right? Because of there's no interest deductions and the requirement of the investors is very high. But the disadvantage with the loan is that payments are compulsory, right? And then with equity, you can pay dividends as you wish, right? So it is not a forced payment. So this might affect your cash flows. So you can evaluate with that. So I saw a question. Can I take it? Any questions? Nomfundo?
I just wanted to say that Mina, I don't mind you taking another hour to actually answer question D, because in actual fact that's what I was waiting for, and now I'm just like, I don't know what to do because you didn't answer that question today. Like a question in relating to that topic.
Okay. I don't know, but I was planning to go through part D because of we haven't touched it in the bootcamp. So I'm going to do it with my students maybe on Sunday, right? Morning. Then I'll let you guys know what I think. Am I putting you guys in with my students, or I'll hear what they say if they don't mind?
Okay.
Yes.
Okay.
Any
I
questions?
don't think you'll mind.
You don't think you'll mind?
No, the more the merrier.
Okay.
Oh,
The more
and
the
then
merry.
for and sorry, yeah, for E and you didn't touch ratios in terms of the scope.
Because I don't believe they'll be assessed.
James,
Oh, all right then.
James,
Yes,
I also don't mind you like including the students that are here because we all want every one of us to share, I mean, to pass. So for me, I wouldn't have issues with that.
okay, no problem.
Yeah, we're a cool bunch. I think we can come
Yeah,
through.
we all need to pass. When we win, we
Yeah,
all win.
Okay,
and they probably have questions that we don't have. So
no problem. I'll share the link in the bootcamp group there.
Jane, sorry, can I ask you a
Yes,
question? With regarding to your tutorials, are they usually at 8 during the week or only weekends?
they are mostly almost every day, I can say almost every day. Normally they start at 6:30, sometimes to plus minus 10 p.m. and then sometimes during the day, and Saturdays it is mostly during the day or in the evening. Yeah, it depends. It depends.
All
But
right, thank
mostly
you.
during the week it is after 6 to 10 p.m. during the week, Monday to Fridays, unless if there's no class for the day. Yes, and then Saturdays, maybe in the morning or the full day. Just like tomorrow, it's a different situation because of we are having a 6-hour class of accounting for groups. So it varies.
Can I ask a question? The James, the topics you gave us, these are what's coming in to Monday's paper. Am I right to ask?
Yes. So when you start studying, this is your priority. Master
So
this one.
that one, okay.
Yes. Then after, master this, right?
The risks.
You should be able to pass if you master this two. Then when you have time, or if you don't have time, go through the source of finance. So it
Sorry,
cannot
so
be
you're saying, sorry, sir, you're saying we must master the work
what
calculation and the strategy.
strategy and risk are together, right?
So all those two goes together, and then the work one.
Yes, and then thirdly, sources of finance. Then this one you can do it when you have time.
So basically, for Monday, it's the first three.
It's for Monday you have to know this five,
Okay. Okay.
but study priority should be
Okay.
in this order.
Okay. Thank you.
Yes.
James, can
Yes.
I ask something, please? In terms of the working capital, like what is like an example of questions, type of questions that we can expect, maybe?
Part B is also integrated with working capital in a way, but sometimes they can ask you, which really so, but theoretically you can answer a question, or part D that we'll be looking at on Sunday is also integrated with working capital a bit. Right. So this
Okay,
is
I'll wait for Sunday then.
yes. Nolutando.
Um, how do you compute to get the NPV, please?
How do I?
I'm using a sharp calculator.
You are using a sharp calculator. So what you essentially
Yes.
do is that you take the cash flow amount, right? Obviously, for year 0, it would be 0, right? So you take 0
Yes.
CFI, right? 0 CFI.
Oh, okay.
You take this amount CFI, take this amount CFI, take this amount CFI, take this amount CFI. Then when you are done, right, you click your second function, right? And then CFI. So second function, CFI, and then you put in your interest. And then you click enter, and then you compute for the NPV. So you just click compute, then after you scroll down and click compute.
Thank you so much.
Pleasure. So any further questions?
James, the Sunday class, is it going to be in the morning or late? Because morning, we need to go pray for the MAC exam.
It's going to be
Oh,
midday.
Sandra.
Yeah, we're going to church. It can be, please.
We
Yes,
need to
midday.
pray. Midday, okay.
Yeah, midday. Any further
And
questions?
tomorrow you said 6 hours. This 6 hours story, is it
Yes.
this like 6 hours, like
Obviously with
like
breaks in
one
between.
after the other, or it's going to be 2 hours break,
You
2
can't
hours?
believe.
I'm
Oh,
just in
Mara, Sandra.
disbelief.
And you must come prepared the 4 questions, Sandra.
I missed the 6 hours. What's happened with the 6 hours, guys? I joined a bit late.
Press.
Yeah, obviously we're going to do a question, take a 15-minute break here, and then we'll have a long break, maybe of 45 minutes max, and then we come back. Maybe a 15-minute break, then a 45-minute break, then the last 15-minute break.
Will it be tomorrow, James?
Yes, 9 a.m.
Oh, shucks.
Yes.
And they mustn't forget, they must have done 4 questions of groups prior to the class.
Yes. They mustn't forget. You are right, Sfundo.
Don't have time. Don't have time.
This is for fact.
I knew it.
This is for fact.
Yes.
That's why I'm confused now. Now I'm still on management accounting. Okay, I get it.
So good night, everyone. I'll send everything later today. If I fail to send everything later today, you'll get it when you wake up.
All right, thank you.
Good night.
Okay, good night, everyone.
Thank you.
Thank you, James.
Thank you so much.
Sandra,
Good
say hi
night.
to